Ladies and gentlemen, today is March 16th, 2026, and I want to talk about stagflation. That is a period when inflation rises while economic growth slows. Now, traditionally, the assets that do well during a period of growth struggle to perform during a period of accelerating inflation, which is traditionally marked by higher interest rates and tightening financial conditions. Now, this is sparked due in part to the fact that I believe we're in a commodity super cycle. And also, this comment here sums up the conundrum quite nicely, which is he says Fisher's ultimate rule for war was simple: never sell on a war scare. He believed that even if a war is devastating, the recovery of stock prices driven by devaluation of currency is historically certain. Be that as it may, this disregards the depreciation of the currency unit. And we have this nice reply here, which is sure, but it might take 10 years, in which time your recovery in nominal terms is worth much less in terms of purchasing power. Very astute reply. Now, as it stands today, this is the first time in history that trading has been halted across all LME contracts, London Metals Exchange contracts. Which brings us right to this article, which is which assets perform best during stagflation. In this article, we analyze the stagflation era of 1968 to 1982, a period with high inflation and limited growth. Paul Volcker eventually had to raise the Fed funds rate up to 19% in June of 81 in order to restore monetary stability. We analyze this data from NYU Stern, which analyzes returns on stocks, bonds, and treasuries from 1928 to 2024. The bullet point here is we are comparing the nominal return of various asset class against the real returns. So the public pays attention to the nominal returns. They think that they're doing quite well, and they fail to calculate the real returns, which is your nominal return minus inflation. So, in short, we have the total change, which is over this period of 68 to 82. The total change for the S&P 500 was 146%, Treasury bills 177%, 10-year Treasury 124%, corporate bonds 162%, real estate 180%, gold was up 1,070%. And during this period of time, consumer price inflation, which is the broad measure of inflation as reported by the government, if we assume that this is accurate and not underreported, we deflate each of these assets to get a real return on the S&P 500 of 8%, Treasury bills with a real return of 22%, the 10-year with a negative 1% real return, corporate bonds return 15%, real estate returns 23%, and gold, if we do not deflate, still stands at 1,070. If you do deflate by CPI, then that would yield still a 416% gain. Now, the reason we don't deflate is marked here, which is gold historically functioned as money itself rather than as a financial asset. If gold is treated as the monetary unit, CPI already reflects how fiat currency depreciates relative to goods and services, while changes in the gold price represent the repricing of that currency. Now, herein we have the nominal returns by asset class for each year. So you can look and see that in 1968, the S&P 500 returned a 10.8% return. And then we look at consumer price inflation, which went from 4.7% to all the way up to 12.3% in 74, back down nominally to 4.9%. Still, significant inflation rate during this period in time, reaching a peak of 13.3% in 1979. By 1980, CPI was 12.5%. And finally, in June of 81, Fed funds reached 19%, and the monetary state of affairs got under control at that point. CPI declined to 8.9%, and then finally in 82 to 3.8%, for an average of 7.35% per year. And if you deflate each of these by CPI, you get the annual return for each asset class. Now, here are the key observations that you take away. The gold dramatically outperformed all financial assets. Equities roughly tracked inflation over the period. Long duration bonds were severely impacted by inflation. Treasury bills performed relatively well, and real estate produced modest nominal gains. We then look at interest rates and equity valuations. So the 10-year in 1968 was 5.8%. The S&P 500 traded at 18.1 times earnings, which if you inverse the PE, you get the EP, or the earnings yield. And so the earnings yield, when you have an 18.1 PE, you get an earnings yield of 5.51%. So what we illustrate here is that the 10-year yield went from 5.8% in 1968 all the way up to 13.9% on the 10-year by 1981. And over the same time period, the PE ratio that the market was willing to bid for the S&P 500 went down. Or conversely, the earnings yield that the market required in order to take risk by buying risk assets went up, roughly on par with the 10-year yield. So you'll see that in a year that it was 5.8%, the earnings yield on the S&P 500 was 5.5%. Fast forward by 73, 10-year yield was at 6.8%. The earnings yield on the S&P 500 was 8.1%. All the way to 1982, when the 10-year was at 10.5% and the market had multiple compression down to such a price that the earnings yield was 9.8%. And lastly, we price the S&P 500 in gold. So if the S&P 500 traded at 103.86 in 1968, gold before Nixon took the U.S. off the gold exchange standard traded at $35 an ounce, meaning that it took 2.97 ounces of gold to buy the S&P 500. Now, fast forward to the end of the period, and you see that the S&P closed at 140.64, and gold traded at $447 an ounce, meaning that it took 0.31 ounces of gold to buy the S&P. So you see there was significant multiple compression over this period, and during this period of stagflation, gold significantly outperformed every other asset class, such that financial assets did not do very well and real assets benefited significantly.